You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everyone. This is Buck Joffrey with the Wealth Formula Podcast. Starting out by reminding you that there is a website called wealthformula.com, and you should check it out for all sorts of free resources available to you. One of the things that you should consider, if you have not already joined and are an accredited investor, you should join our investor club. All you have to do is sign up. You go to wealthformula.com and you'll see something there that says Investor Club. This is for accredited investor. Accredited investors are investors who make $200,000 per year or $300,000 per year if filing jointly, or have a net worth of $1 million outside of your personal residence. If you meet those criteria, you are an accredited investor. You don't have to apply for anything. You either are or you are not, just like being pregnant. You are pregnant or you are not. It's not something you need to apply for. It's very clear once you just look at your own finances. Anyway, that's where the magic happens. Check it out, wealthformula.com, accredited investor club. Now, let's talk about this crazy time, right? And specifically, let's talk about the stock market. Now, a few days ago, we had the worst single-day loss in U.S. Stock market history in the Dow Jones Industrial. And then the next day, we had the best day in the Dow Jones Industrial in 80 years. Now, I have no idea what kind of volatility there will be between the time I actually record this podcast and by the time you listen to it, because usually, there's at least 3 or 4 days in between. And right now, 3 or 4 days is like, night and day in the stock market in terms of volatility. But don't you think this is kind of ridiculous? I mean, seriously, this kind of volatility is exactly why throughout my adult life, I've stayed away from stocks. The reality is I just don't get it. I don't get them. How does, for example, the fall of the Dow down into the 1800s happened because, well, I guess the Congress couldn't get their fiscal stimulus through. Okay, everybody knew they were going to do it eventually, right? So then all of a sudden the floor drops out, right? And then a day later, there's some agreement and everybody gets excited. $3 trillion thing going through. Everybody's excited about that, and boom, just like that, biggest day in biggest day in 80 years for Dow Jones. Again, I don't get it. I just don't get it. For example, so you take this fiscal stimulus and the optimism that people have in the market. I don't understand why there's optimism, right? I mean, the economy's frozen. For all practical matters, there's about a 90% effective unemployment rate now, meaning 9 out of 10 people at least are not going to work and can't go to work, right? That's nothing that any kind of monetary policy, any kind of fiscal policy, none of that is going to make a difference. This is a health policy type situation right now. That's the only way it's going to get better in the economy. Now, listen, the economy is frozen, and that's for sure. And to me, there's no doubt that there's going to be a deep recession. It might be short, but there will be a deep recession. It's just unclear how long it's going to last. But the idea of the value of stocks like going up and down in the Dow Jones Industrial by, a couple thousand points over a day or two is just crazy, right? What does it all mean? Anyway, to me, the best word that describes this economy and the markets right now is uncertain. or uncertainty. And as an investor, that is probably the worst feeling you can have. If you feel uncertain right now, one thing that you will really benefit yourself in doing is to remember what this feels like so that the next time it happens, you'll actually be prepared for it. You know what? It's going to happen again. Something will happen again. Black swan events, they call them, they happen once in a blue moon. And guess what? They still happen. And every time, everybody's really surprised about them. Now, it's not like I thought this was going to happen, but the reality is that something like this can happen at any time. It really can. And we just have to be prepared for that kind of thing. So as I've made clear on, several times in this podcast, particularly last week and last week's podcast, etc., the webinar that we did with Christian and Rod, I hedge these types of uncertainties in life and financial life through contractual agreements that I have made with life insurance companies. And these life insurance companies, I trust these contracts because they've consistently paid through the Great Depression, multiple world wars, bank failures. Cash value life insurance policies like wealth formula banking, which we've been talking about, really does help me sleep well at night. Now, again, we spent a lot of time on this last week, and if you're not sold on the concept and don't want to get a policy or don't think it's for you, totally fine. I get it. But, I think it's just really important to me that you understand it. So if you have another way you're going to get some sort of security in your life, then do it. But get security in your life. I just want you to understand this as a possibility. Because I actually really believe in these life insurance products. And I think historically they've been more stable than banks, right? I mean, positive payouts, dividend payouts since the Civil War. That's pretty good. Anyway, this week, what I want to do is give you another way that you can get exposure to these kinds of, what I would call hyperstable assets. You can get exposure to these same kinds of life insurance companies without having a policy yourself. You could actually buy someone else's policy. You could, and this is called life settlements. That's what these are called. Now, if you've never heard of these strategies, if you've never heard of life settlements, I'm not surprised. It's not something most retail investors will ever know about, never hear about from their wealth advisors. Meanwhile, you've got the ultra-high net worth folks like Warren Buffett. Warren Buffett buys about $600 million per year worth of life settlements. Bill Gates has about $500 million of life settlements on his balance sheet. Why? Well, if you're curious, you are going to want to listen to this interview that I did with Tim Wright from ASR Alternative Investments when we come back. Welcome back to the show, everyone. Today I have Chief Marketing Officer of ASR Alternatives, Tim Wright, to speak with us a little bit about this asset class known as life settlements. Tim, welcome back to the show.
Well, thank you. It's always a pleasure to be on your podcast. Thanks for having me.
Yeah. Too bad in these circumstances. I know your practice. This is a good way to practice social distancing, though. We have a screen between us and several thousand miles. You're in Dallas. I'm in Santa Barbara, California here. Well, listen, again, thanks for coming back on the show. And I want to start out talking about some basics before we kind of launch into this entire concept, because it's really based around, again, permanent life insurance. And we have been speaking in the last week or two a fair amount about permanent cash flow life insurance concepts. We've been talking about, banking and leveraged IULs and things like that. But let's go back before we, kind of launch into life settlements. Tell us about, the role of life insurance companies in times like these, right? In times of uncertainty, and what we can glean from the past when it comes to the financial stability of these types of companies?
Yeah. So let me just first by saying, if you're talking to, Buck, about life insurance at all, I mean, one of the things that you'll notice with us is that we're very much aligned with the insurance industry. And if you like life insurance for the assets or the valuable characteristics that life insurance has, you'll really enjoy and appreciate life settlements because there's so many similarities. So when you go back in time, Buck, you have to go back almost, over 100 years to 1911 when all this started. And that's when they didn't call it life settlements back then, but that's when it all started, 1911. In fact, there was a court case that made this all legal back in 1911, a Supreme Court case. So we have a lot of history, but the reason that we love the asset of life insurance is that it does go back 150 years. The legal reserve life insurance system that I'm sure you talk about with your clients all the time is what works well for our asset class. And what does that mean? That means when there is a death claim, guess what? It's going to pay out. And the life insurance company, that policy, that is the underlying asset behind this whole thing. And that's the beauty of it.
Yeah. And so we talk about specifically the emphasis, again, going into, I've called this, obviously it's a debatable issue, but perhaps the most stable asset in American history in that regard, in the regard that really, if you look back since the Civil War and you take a company like, Penn Mutual or Mass Mutual or any of these companies, they have not only, continued to follow through on their contracts since through the Great Depression, through multiple world wars and Korean War, hyperinflation, et cetera, but they've actually managed to not only pay the contractual, required payments, but they've actually even paid dividends. And so that created a significant, a loyalty, particularly around, people who lived through very, very hard times. I remember hearing that the people who lived through the Depression, for example, typically they would be people who had really either kept their money in cash or they kept it in life insurance, and they didn't really trust anything else because as the rest of the world crumbled around them, their life insurance policies never failed them. They became the sources of liquidity in addition to investments.
Yeah, no doubt about it. I mean, that Great Depression taught all of our grandparents a valuable lesson. And unfortunately, I think we're coming back around here as we see some of the stuff that's going on right now in the market, especially. There's a flight to safety. But for many years following the Depression, that's what people did. They built up cash value in their life insurance policy. They used it for loans. They used it for tax-free retirement. And we've gotten away from that as a society. I think that's going to start to swing back as time goes on. I really do.
Well, I think part of it happens, in my opinion, what seems to happen is that the farther we get from really, bad financial situations, the farther we get from 2008, the more we fall back into those habits. The Great Depression lasted for many, many years. The people, and there wasn't the type of safety nets that there were even through the last financial crisis. And I think those kinds of things really hit people, and they remind them that, hey, upside is great, but what is your, what kind of investments can you make that are maybe less sexy, but you won't be up at night. So I think that falls in this. Now, let's talk about, for those who don't know, I mean, what exactly is a life settlement? Can you kind of describe the process? I know you talked about something, really starting back in around 1911. Maybe you could go through that story.
Yeah, the Grigsby versus Russell story is a great one. There was a doctor who was taking care of a patient, and the patient could not afford for the services of that doctor. And the insured did have a policy, and he said, well, in exchange for dollars, can I give you this death benefit? And he did. He gave it to them. That person ended up dying. The doctor went to file the claim, and the claim was denied. And at that point, that brought up the big question, can you gift or give or sell your policy to someone? And that ended up going to the local courts, went all the way up through the Supreme Court. Took a while for that to happen. But when that happened, that the judges decided that, you know what, at that point, they decided your insurance policy is your property. Just like your car, like your watch, like a house, you can do whatever you want with that policy. They do not have to have an insurable interest to give or gift or sell the policy. They do have to have an insurable interest. You know, if Buck, for example, if I said, hey, you know what, Buck, I'm going to take a policy out on you and I'll pay the premiums, I can't do that because I don't have an insurable interest in Buck. If we were true business partners in, let's say, an LLC, that would be fine. But in this case, we couldn't do it. But Buck could sell me his life insurance policy. Now, 80 years went by, Buck, before there was really ever an industry that was created in the 90s and certainly in the 2000s that went on. That was a bit of the Wild West. We'll talk about that in a moment. So the insurance companies loved that 80 years because this wasn't something that was going on a whole lot. But when push came to shove and there was an opportunity for someone to sell their policy, they went all the way back to 1911 and recognized that this was a very established law.
All right. So you hit on, let me ask you this. I mean, it may seem obvious to you and me, but just to put this into, perspective, why would the insurance companies not want you to sell your life insurance policy?
Well, the insurance companies do a lot of great things. Okay. They offer protection, tax-free growth, all the, borrow from your cash value life. They offer security for your family and your business. But the one thing we know about life insurance policies is many of them lapse. Mm-hmm. And that is the insurance company's profit. So for them to come out and say, yeah, go ahead and sell it, no problem, back in the 30s, 40s, and 50s, that wasn't something that they were just going to voluntarily do.
So yeah, I mean, and I've emphasized this before. We did a webinar on hedge. There's a site I did a webinar on called hedgetheeconomy.com, and we covered this there a little bit. But one of the things that people when they first see this kind of investment, they think, well, gosh, it's kind of morbid. But in reality, let's think about who that person who is selling their life insurance policy is. Who is that? Well, Tim, why don't you answer that? Who is that person, and why is it beneficial for them to sell their policy?
Well, it's interesting. We've been in business for 15 years now. And if you asked that question 15 years ago, people truly would have no idea of that answer. But because you see on Fox and CNN and a lot of networks advertising companies like Coventry and Harbor Life Settlements, people are more aware of it because they're seeing these commercials, right? They're seeing things in the newspaper and online. So the reality is the insureds who are selling their policy, and this was what it really was. What the number one, I guess, objection today, it's really not, but let's address it, morbidity. Well, people say, well, gosh, isn't it morbid? I got to wait for somebody to die before I'm actually going to profit. Well, we do things a little bit different. We don't just buy one policy. We can talk about that offline. But the reality is the people that sell their policies are fairly wealthy. They have bought larger policies, $1 million to $10 million policies for estate planning purposes. Mm-hmm. They're sophisticated individuals who went to their CPA, went to their estate planning attorney and said, you know what, Bob, I don't need this anymore, or I can't afford it, or my family is out of the house, my kids are out of college, my business is sold, whatever it might be. I don't have this need for this insurance policy anymore. And by the way, they're expensive to own, right? I mean, right. They're great to have, but they're expensive to own. So the CPA says, well, why don't you sell your policy? And I still think this happens to a certain extent. People will say, well, wait a minute, I didn't know you could do that. I think a lot of people do know you could do it now. So that starts the whole process of discovery, figuring out you can sell it. How do I sell it? How much do I sell it for? What's that procurement process? It's a lot like a house. So that's basically, hopefully that answers that question.
Yeah, no, it does. And I think that's an important distinction, right? You're not you're not going after people and, pulling a life insurance policy off their deathbed. These are people that are looking rationally and saying, okay, I don't really need this thing. And rather than just, okay, my kids are fine, they don't need this money, but I really, I could use a little bit more cash while I'm still living here. And if they're going to bring it back to their insurance company, the insurance company would be happy to give them their cash value because it's almost certainly not going to be anywhere near what the death benefit is. So really what they're saying is, okay, where can I get the best money for this? And it works out to their advantage to actually sell it because they're going to get more from a company, as you described, the Coventrys and the Harbords that you're buying these things and brokering these things out, than they are from their insurance company's cash value. So that, I think, is an important distinction to understand. You're actually helping people. You're not,
very much.
You're not a vulture here waiting for them to die. You're actually doing them a service by giving them more money today. I mean, just think about it right now, okay? Say somebody's got, somebody is in their 70s or 80s and the market just tanked by 30% and they have funds, but they're like, you know what? I don't want to keep withdrawing money from a market like this where 30% has gone down. Maybe I should sell a policy. Maybe I should do that. That would be a good way so that, I'm not, burning through all of this money that just vanished in the equity market. So that's the kind of way you have to kind of see this.
Hey, Buck, one thing I want to point out too to your listeners is that it's a real discrete asset. If I have a cash crunch, and that many people do, sadly enough, based on what just happened with business people laying off their workers, cash flow is short. I don't have to sell my house. I don't have to sell my car. I don't have to sell my country club membership. I can literally sell a policy. It might take me a month, might take me a couple of months to sell it like it would a house, but no one has any idea what just took place. And instead of lapsing the policy like a lot of people do out of desperation because they can't pay their premiums, for example, I'm not saying that everyone in this situation is in that boat, but some are. Instead of lapsing that policy, now we're going to take that piece of paper that's worth nothing to the person and sell it for maybe 10, 20, 30 cents on the dollar. That is helping this generation out a lot.
Right. So you talked about this a little bit there. One of the questions I get is this legal? Well, obviously it is legal. There's a Supreme Court case that made this legal way back. Who are the players, right? I mean, this becoming a retail asset, things that people could, like you and me, accredited investors typically, could participate in is a fairly recent thing, but it's not new, to larger institutions. You want to talk a little bit about that?
Yeah, it's about 95% of the whole market is institutionalized. So you're going to see hedge funds, banks, insurance companies, in fact, are big investors in this as well, not buying their own policies, but buying other insurance companies' policies. So the retail side of this has been around for probably 20, 25 years, say the retail, the mid to high net worth individuals. But I'm always surprised, and maybe I shouldn't be because I've been doing this long enough, 12 years I've been doing this, that there's so many people that are really sophisticated individuals. I mean, your audience, for example, I've talked to a number of them, really, really bright, smart people, but they don't know about this. And that's because Wall Street isn't going with the big houses, the retail houses, and buying these for the big brokerage houses. So you're not going to hear about this from your financial advisor. What you name the company, okay? There's thousands of them out there. You're not going to hear about it from them. And that's one of the reasons that I think even sophisticated investors aren't educated on life settlements.
Yeah, and meanwhile, you've got Berkshire Hathaway buying a couple $100 million of life settlements and doing arbitrage with them. You've got, Bill Gates has a big portfolio, I understand. So this is stuff that's been around. Talk about, so we have this, obviously when I first learned about the concept of life settlements, I was like, that's great. That's a great idea. And I want a piece of that, right? When I started doing due diligence, and this is ultimately how you and I met, I realized there was a little bit of a troubled history, you can say, in this asset class as it, really first started out becoming available to mom and pop investors, and particularly maybe around the AIDS crisis and that sort of thing. Do you want to talk a little bit about sort of the Wild West of the past and what kinds of things have been, that you and more of the straight shooters in the industry have done to create more of a regulated environment?
Yeah, it's really a great story. It's a fun story to kind of go through because it gives you the full scope of where we've come from. But yeah, if you went back to the late 80s, early 90s, as especially a lot of you have a lot of doctors on here, know that our country is going through a really rough time with the HIV/AIDS epidemic. And we're talking about another epidemic here, a pandemic. And it was a scary time for a lot of people. And so a lot of the AIDS patients, the full-blown AIDS patients, they were 30, they were 40, they didn't have much of an estate, but they had these, policies they had through work, or they bought a small policy through time, and they had $50,000 or $100,000. Well, what was happening is investors came along and said, well, listen, I'll buy this for 25, 30 cents on the dollar. And they have a life expectancy of less than 2 years. Remember, it was a viatical. Less than 2 years is what the definition of that is. They were terminally ill. And everybody kind of won in that situation, because here you have this person that was going to, live out the remaining years in dignity, have a little bit extra cash to spend, and then the investors were also getting a payout upon that death benefit. That concept was a real pure concept, and that's how it started. But because it was new, it was not regulated, unfortunately, and it wouldn't have been because it was so new at the time. Well, there were some bad actors that came along, and you could say all 90s, from 91, 92, all the way to really 2004, there were some good players, but the bad actors really outweighed in terms of the media and the voice of this industry. So if you heard about it or you did a search online back then, you saw all the bad stuff that was going on. Well, thankfully, by the mid-90s, late 90s, regulation started to kick in. But it really wasn't until the mid-2000s that there were regulations on both sides of the market. So what I mean by that is, if you think about a real estate transaction, you have a sell side. That's the insurer who's 85 wants to sell his policy. And then you have the buy side. I'm the person that wants to go buy the house, or in this case, buy that policy. Well, there was a lot of greed and people taking advantage of the senior citizen market when selling their policy. And that was something they dealt with a pretty heavy hand. There was companies that were really doing some really bad things. I won't go into the details. You could probably go into American Greed and hear some of them. We started 15 years ago, so we were kind of in that mix. So what we decided from day one is, listen, there is great opportunity for everybody here. The insured who's selling their policy, the investors, us as a company, the advisors out there that are offering this strategy to people. So, pigs get fed, hogs get slaughtered, right? The old saying. So what we said is, listen, we're going to go above and beyond and add a level of transparency into our business that no one else is doing. And so that really helped catapult our business, because before you would talk to a company, they wouldn't tell you anything. In fact, you might not even know the insured's name. You might not know how old they were. It was kind of hey, trust me, I got this group of policies over here. We're just going to have you put money into it. And a lot of those ended up being pretty negative overall. So we have really attempted and tried and really perfected this process of making sure that not only is there a level of transparency, but we're following all of the regulations that are fully established now. And you go into 2010, 11, 12, even more things came out. So if you're a bad actor, or if you're a Wild West guy working in 2020, you're going to be doing that for about a month, and someone's going to be knocking on your door and asking a lot of questions. So we're very proud of the way we set this up. The companies that we work with are phenomenal companies, and we're really proud of the whole process.
Well, you talk about the process, because even that is very controlled. I mean, you don't go out, you're not knocking on people's doors. I mean, there's a process that you as the master fund go through to acquire these that is no different from the way Berkshire Hathaway is, right? I mean, you want to talk a little bit about that process?
Yeah, I'd like to talk about the provider network. The providers are really the ones that you could say kind of oversee the whole process. Without a licensed provider, you could never do this. And I kind of view that as kind of like the broker in the real estate transaction. You can do some for sale by owner in real estate. It doesn't happen a whole lot. Why? Because the ball gets dropped and there's something that happens and it ends up being negative. So that's why you go through a broker typically in real estate.
Well, sometimes I think of that broker that you're talking about, life settlements, is almost title insurance, right?
Yes, you're right. It is. They're the equivalent to a title company, actually, in the real estate transaction. So you want to make sure that you're going through, and that's what we do, licensed providers. Now, what do? A licensed provider works with both sides of the life settlement world. We have on one side the buy side, which would be us, ASR, Alternative Investments. And on the other side, you have the sell side. So the sell side is really represented by a couple people. One of them is going to be a broker, a life settlement broker that's working with insureds and the insured themselves. So, you have a client who's 85 years old. He probably doesn't have the wherewithal to go to the provider, but the life settlement broker does. And so at that point, there is a process that they go through. They decide they want to sell. So they do a HIPAA release form. They get the life expectancy analysis on typically one or two companies right out of the gate. They do a full review on the policy to ensure that it's transferable and that it will pay out upon the person dying. And then once all that's established, then the provider would open it up to a company like us and other companies and say, all right, we've got the Smith policy. He's 85 years old. He has a life expectancy of 60 months. Do you want to start bidding on this? And at that point, we say yes or no, depending on our available funds. And if we have the available funds, we say absolutely. And so we start that process.
So, and at that same bid, you've got all the major players who want to do it the right way, right? I mean, you've got the banks, you've got the hedge funds, you got Berkshire Hathaway, all those doing it the same way. So this is kind of the tried and true way of doing that.
That's right.
Let me shift a little bit and ask you this. When you mentioned that there's the bidding, right? What is the master fund's buy box? Because, we talked about how Berkshire Hathaway actually buys a lot of different policies. They buy younger people, might hold them for a couple of years and then sell them to somebody else, because that person may have developed a health problem and all of a sudden that becomes a more valuable tool. It's a completely different model. That's not what really kind of philosophically what you guys have, I think, or you guys are about. But what kinds of things do you look at as a master fund to potentially add to your portfolios or philosophy?
Yeah, and Buck, you can look at this in any business. There's going to be some that are really aggressive in any business and some that are more conservative. ASR is definitely more on the conservative side, and here's what I mean by that. What we're looking for is a really unique policy, and they all kind of look about the same, but of course they're all different. We're looking for a policy where the insured is about 85 years old. They have a life expectancy of about 5 years, 60 months. Life expectancy come in months, not years. We're looking for a policy that's institutionally rated at A or better. It can be A minus, but A minus or better. So this is institutional paper that we're buying. The policy has to be beyond the contestability period. That's if it's below 2 years, which is contestability in insurance, in the insurance world. That's called a wet policy. We stay away from wet policies. Why? Because the insurance company could, if they suspected something was odd in the process, could come back and contest that. Once it's beyond 2 years, they can't do that. We also look at the policies that do not have open suicide clauses. Our maturities, we call them deaths, are not caused by suicide. I don't think we've ever had that. But we want to ensure for our investors that if there was an open suicide clause in the policy, that would not come back to hurt us if that's what in fact happened to have the maturity. So there's a number of things. The person has to be a U.S. citizen. The policy size is between 1 and 5 million. I'd say on average about 3 million. That's the death benefit, not what we pay for it. So there's a few things like that fall into this parameter, and we won't even look at a policy.
Right. And you're also looking for older people and people with health problems. 85 health problems.
Underlying health the health impairment. We're looking for health impairments. Now, here's a combination. If you're 85 and you have a life expectancy of 5 years, and I should have just said this because it's so obvious to me and you, but I'll say it for everybody, is that you have health impairments. If you're 85, you have health impairments, but you could be a healthy 85. So what we're looking for is not an 85-year-old with a 90-month LE. We're looking for an 85 that has a 5-year LE.
One other thing I'll clarify, just so people understand, and this is something I learned, just through my background in life insurance, is that 2-year contestability. What is that? Most insurance policies, basically after 2 years, they have to pay, right? They have to pay, whether it's, suicide, whether it's, they can't go back and research stuff after 2 years. It's basically done, right? Is that right in terms of the way I'm talking about?
They have 2 years to do all of that. And if they don't do it by then, all bets are off and it's going to pay off. And that's been legally challenged over the last 150 years. And it's really, really solid ground.
Now, let me ask you this, because you just mentioned, again, this was a bidding process and you have your buy box. And if you're talking about a buy box of people who are 85 and have, other problems, comorbidities is what we call them in the business of medicine. I have to ask you, even though it may sound a little morbid right now, but are those policies going up in price because of coronavirus? Because those are the people who are most likely to, be affected and ultimately have the highest mortality.
It's probably too early to tell, to be honest. I will say that our provider network, and there's about 25 licensed providers. There's probably about 10 that are good size around the country. We're not exclusive to any one of them. We'll work with anyone that's out there. But we have a few that we get most of our policies through, and we've had these conversations with them in the last few days. It's not substantiated, but anecdotally, there are people that certainly have taken a massive hit, and they're looking for liquidity. And so the phones are ringing a little bit more with companies that are brokers and providers looking to really procure those policies. The other side of it, which is exciting for us, is that we're not an institutional player. Like you said earlier, we're a retail player that operates funds. And so when we think about the institutions out there, what they're doing, what we see them doing, is just holding off a little bit, right? They buy 95% of the policies out there. So when they hold off, prices drop a little bit because there's not the competition, supply and demand curve. And so, again, a little too early to tell, but there's always an ebb and flow in this business. We're seeing things right now.
Prices are potentially going lower, even though the risk is actually higher to these people, for the fund at least, to buy something right now.
Right.
So, so we've talked a lot about, I think it should be pretty clear what the benefit of this kind of thing is. There's no such thing as something without risk, right? So tell us about what are the risks of this kind of investment? And, put it in perspective compared to some of the other things we consider as safe investments.
Well, you're right. I mean, this is going to be on the lower scale of risk. Why? Because you have major insurance companies that are backing the policies. They're the ones paying them out. But you have a couple of risks that we like to talk about right up front. We don't shy away from a risk, and they're really obvious risks, actually. There's nothing really too surprising about them. And the two are longevity and illiquidity. So when A third-party medical underwriting company comes back and says, well, Mr. Jones has a 60-month LE. They're not saying that Mr. Jones is going to die in 60 months. What they're saying is there's a 50% chance that he'll die before or he'll die after that LE. So if Mr. Jones dies in 70 months or 80 months, we're still fine. We can still make money well over the life expectancy. If Mr. Jones lives 120 months, then there's going to be some additional risk because the return that we were shooting for, we're not going to get. But this is why we buy multiple policies. It's not just one at a time. That's longevity, which is pretty obvious. Now, I will say the opposite is also true. If the person dies earlier than that 5 years, let's say they die in 1 or 2 years, then the return is much higher at that point. The illiquidity is a risk because this is going to be money that you're not going to want to touch for quite a long time, 3 to 7 years. It could go as long as 10. What we try to do is close out funds as quickly as we can, even if that means selling them selling a policy in the 7th or 8th year. So the illiquidity is perfect. It's a perfect connection with qualified money. I'd say 60, 70% of the money that we bring in is from an IRA, it's from a 401k rollover, a SEP, something that is qualified. Why is it a good marriage for qualified money? It's because you can't touch your qualified money for a long time anyway. And it just grows tax deferred, and then you go from there. So those are the two big ones. There's a couple others I'll just share with you. Track record, working with a company that has one, which we do. Third-party escrow agents. I don't know if we have time to get into all of that, maybe not, but we work with some of the very best third-party companies that you can. These are third-party administrators, making sure that you have a good bid process so you're not overpaying for policies. If you're new in this business and you don't know who the players really are, you can get caught up in a little bit of that, overpaying for policies. And mitigating the premium call exposure. And the way we do that, because as you know, as I said earlier, these premiums are quite a bit every year. So what we do is we escrow premiums within the acquisition cost when we buy a policy for a number of years. And so it would not be prudent for us to buy a policy and have only 1 year of premium in it. It might be 2 or 3, or it might be 4, 5, or 6 years of premium. And that's kind of our average. So those right there are the risks, and then how we mitigate them, a little bit about that as well.
So many people know already we work with ASR within our accredited investor group. This type of investment is limited to accredited investors, and Tim and actually Stephen Ziadi as well will probably be joining us, but we'll be doing a webinar for our accredited investor group, probably to get a little bit more information, which we can't really get into necessarily in this kind of forum. For our accredited investor group sometime later on this week. You should get an email on that if you are in the investor club. Tim, is there anything else that you can tell us to wrap this up and have any sort of overall big picture on how to look at this stuff?
Well, yeah. I mean, like I said, I've been in this business for a long time. We've raised a lot of money. We've owned a lot of policies. And when we look at the foundation of someone's portfolio, we think of cash, right? We think of cash. I think right above that somewhere, and this is certainly debatable, but I do believe that life insurance, whether that's permanent life insurance or life settlements and life and settlements, really creates a nice bedrock. If you're building your house on a solid foundation, you've got a nice foundation of those three things: enough cash to live on for a period of time, you've got your life insurance, you've got your life settlements, and then you just build from that. Again, that could be debatable, but the reason that I am so convicted in having a foundation based around life insurance, it's been around for 200 years, and very wealthy people have grown their wealth using that. But it also has a lot to do with the fact that the companies that are behind it are the biggest companies in the world, bigger than oil companies, bigger than banks. Insurance companies are massive. And that allows you to sleep at night, Buck, because you're in a situation there where you know that these companies in the end are going to pay off. when there's a death benefit.
Right. They're contractually liable to do so. They have to do it. So anyway, that is good stuff. I want to thank you again for being on the show, Tim.
Thanks for having me.
And, try to stay healthy and, enjoy your time at home as you're in shelter.
Right. Thank you.
We'll be right back. Welcome back to the show, everyone. Now, a lot of people have been asking me what I think, what's going to happen with this whole coronavirus thing. How is it going to affect the economy, et cetera? Well, as I suggested in the introduction, I think we're going to have a deep recession. I think it'll be relatively short, in the matter of 6-8 months, that kind of thing. And then I think we're going to, likely have some kind of strong recovery. And the reason I think we're going to have a strong recovery is because the banks are in good shape. I think they're going to lend. Rates are near zero. I think that there's going to be a strong recovery. Let me say that I could be wrong, and there's a lot of opinions out there. I had one interaction with a guy on Facebook who, has a real estate investor in his tag, including his name, and he said that he thought the U.S. economy was about to take off because of this stimulus. And I said, well, maybe I'm bullish too, but not for the next 6 months. And he said, we can agree to disagree. And I was thinking to myself, well, yeah, we can definitely do that. And I hope you're right. But how in the world is this economy going to boom within the next 6 months? I just don't see it. If someone can explain that to me, please shoot me an email and explain how that would happen. The problem with the idea is that we're probably several weeks or months away from any sort of level of normal commerce coming back to the U.S., right? I mean, what if the 2 or 3, say 2 weeks from now or a week from now, as some states are showing that's when they're going to pull off their shelter-in-place orders. I doubt that, but even if they did, do you think people are going to hop on planes and start traveling places and staying in hotels? No, it's not going to happen. Listen, this is going to take a little bit of time to normalize, and so I do think that it's highly unlikely that the economy will be booming within the next several months. However, banks are not in trouble. Near zero rates are going to encourage businesses to expand, move quickly, and move out into a post-corona experience. And that's why I still think there's if you look a year out, I still am pretty bullish on what I think the economy will look like then. But again, that's just my opinion. I have been wrong before, and I'm sure I'll be wrong again. But when I look at what's happening, that's my take. Anyway, if you are in Investor Club, make sure you tune in to the ASR guys' webinar this week. If you're not part of Investor Club and you are an accredited investor, make sure you go sign up. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.